Hi, Scott. How are you today?
Doing excellent. Thanks for asking.
Scott, I was wondering how these charitable lead puppet trusts work.
They're the best puppet trusts out there right now.
Right, so I could become a person just by getting into a puppet trust and some sort of software or something?
That would be great if you could become a person. I would really appreciate that.
Yeah, then maybe I could get out of Alan's office and go do something better, like work for you.
I don't think anything's better than working for Alan.
If only you knew. All right. Well, welcome to our program. This is Alan Gassman. I'm here with my friend and colleague, Scott Levin, and we are going to talk about the estate plan of the month. And Scott is the estate planner of the month. He is, we have to talk about his qualifications before we even get started. I hadn't realized it. I knew Scott was smart and I knew he knew his stuff. But Scott, I didn't realize that you have a master's in business administration, a law degree, a post-law master's degree in elder law. You're a certified estate planner and a chartered advisor in philanthropy and a chartered financial consultant and a certified financial planner. How many people do you know anyone that has that many fantastic degrees and initials?
Well, I think I'm trying to catch up with Michael Kitz's. So yeah, maybe eventually I'll pass him.
And what did you say your wife said when you said you wanted to get another certification?
Yeah, my wife was very excited and she said, I think it's a great idea. You just have to figure out where you're going to live.
And then I told you the joke about what do they call a drummer without a girlfriend?
What is that again?
Homeless.
Homeless, yes, exactly.
That was told to me by a very good drummer. So Scott, where are you practicing now, and what are you doing besides practicing?
So I don't actually practice law. I do estate and charitable planning for Westcott, which is a wealth management firm, an RIA, that's been around since 1986, I believe it was. And basically, whenever we have complex planning or even basic planning where some of the advisors needed advice and guidance, I review the documents, I help with the planning, work with the attorneys outside on structuring the strategies.
So you're the guy that everyone goes to where they say, I got a new client or a new client situation, it's pretty complicated, let's call Scott in?
Exactly, that's exactly what I do.
And
I'm the subject matter expert on estate and charitable planning.
Right. And what, besides your education, what kind of books and what kind of tools do you use on a daily basis?
Well, we use eMoney for financial planning, and for more basic estate planning, I use Vanilla for a little bit more complex planning. It shows beneficiaries, fiduciaries, flow charts, and then I use EstateView for the more complex planning. This is the type of planning I started doing in 1999, but I had to use my own tools, Excel, PowerPoint, Word, and having something like EstateView where you could actually take a base case and say, okay, what if we added a life insurance trust, an ILIT, and then let's add on top of that an LLC and gift and sell shares to an IDGIT, and then use a CRUT or a testamentary CLAT. I mean, we're able to show all those strategies and the incremental benefits of using each strategy. And that's just something that I don't think any tool comes close to in the industry.
Oh, thank you. Thank you. I appreciate that.
My pleasure. Thank you for making it.
Yeah, now that I have that testimonial, the show's over, we can be done. So let me start the PowerPoints here. And again, we welcome everyone to this program. Most of you have been on many of our programs, but you're going to be very, very happy to see what Scott has to provide. This program does not qualify for continuing education credit because the puppet is just so bad that they would never allow it. If you have questions, you can click on that upside down pyramid. You could sing the Steve Martin King Tut song, and then you could type in your question. And if we know the answer, we will answer it. If we don't know the answer, we'll make up an answer. Upcoming events, lots of stuff coming up. We're going to have Scott back again for sure. Our friends Marty Schenkman is having a free webinar April 3rd on software products to enhance your estate planning practice for lawyers. So that might be of interest. Also, anyone who's watching this webinar today, you can get a 10-day free trial of EstateView, which we would be glad to onboard you. With respect to that, all you have to do is go to estateview.link and put in your email address and the top secret password, which is March 2025. Please don't tell anyone what that password is, and then you get 10 days of EstateView, whether you want it or not. Also, we have free EstateView workshops that you can attend, whether you are a subscriber or not. You've got them right here on the PowerPoint, so that must be true. And we've got an EstateView library at estateview.info, and you can watch a video on any of these planning techniques. And hopefully Scott will be filming some of these for us. Scott, anything else you want to say for yourself that your wife would agree with?
Well, I just want to thank you for having me on, and I greatly appreciate it. And thank you for the software, because it's just tremendous and allows us to. I said to you, I think it's number cruncher on steroids. It allows us to show so many strategies and the benefits of those to clients. It's very powerful and it's well received.
Oh, thank you. I can't thank you enough for that. So let's go ahead, Scott, with your case study. And not only are we interested in your case study in particular, but then what you normally tell clients and whatever deviations you would normally, see or explain. It's all yours.
Okay, great. Could you go to the next slide, please? Okay, so we have a client that is very wealthy, like many of your clients probably. Back in 2012, he had over 100 million in net worth. Now they're in their 70s. Unfortunately, he's had some health issues, significant ones, and we're trying to look at his situation and come up with a way to negate the estate tax. And we've been doing that over a long period of time. So back in 2012, because of what was going on with potential changes to the estate tax, we had recommended to he and his wife to fund trusts for their children and to transfer the exemption amount at that time, which was 5.12 million for each spouse, to trusts for the two children. And they did that. And the benefits of that are significant. Could you please go to the next slide? So they did that. They also, as the exemption has increased, and recently with inflation adjustments annually, they've been making additional contributions. They've used their full exemption amounts of the 13.99 million a person as of 2025. They also, over time, as their grandchildren were born, funded 529 plans. They didn't just put a one-year contribution in. Because they're able to front load 5 years of annual gift tax exclusions, they did that. And then after the 5 years were done, they put additional amounts in over time as well. And that has grown significantly over time. And then they've also had Roth conversions. The goal was, when he retired, we said, your income is down significantly from what it was, because he was very high up in a major company as an executive. And he's done these Roth conversions and now has 0 taxable IRAs. Everything is in a Roth that's not in a taxable account. So that's going to be very powerful as it transfers to the children. Could you please go to the next slide?
Sure. Are you going to tell us how much they have now from what they've done? Are you going to? I
think I have some numbers. Yes.
Okay. All right. Because it's very interesting how the time value of money and somebody who gets started early in 2012 could have a huge build out.
Yeah, and the girls actually do use some of the money to live on as well as a beneficiary. So, and these are people that spend. You know, they have a private plane and other numerous real estate assets. So their expenses are high, but they certainly have the money to live in that lifestyle. So in 2025, their total net worth is 60 million after all the transfers over time, but that includes approximately 10 million in Roth IRAs, no traditional IRAs. And each trust for the children are worth approximately 30 million today, with the money that went in, the growth and spending at a very high level over time for the families of the children. Now, I think the key is, prior to Secure Act, Roth IRAs were very good. After Secure Act, I think they're even much better, because now instead of stretching out over decades for their lifetime, the children, they'll have a 10-year distribution period. And when you have, you know, even $10 million is a lot to take out in 10 million, 10 years. That could add to your income, certainly, possibly push you into higher tax brackets and create income tax issues. But when the two parents pass away eventually, these children now will inherit in their trusts, their see-through trusts. So, you know, they will get the benefit of the 10-year stretch, and they will have the benefit of not having any taxability on the IRA RMDs because they're Roths. And also, they won't have to take any money out of the Roths until year 10, because there's no requirement, because they're Roth IRAs. Another powerful tool besides the estate tax savings, the income tax savings that will result.
So let's go. So in other words, these people had regular IRAs with a lot more in it that was good, and that was going to cause more estate tax and lots of income tax. So they sent a lot of their money to Uncle Sam in exchange for the privilege of converting those IRAs to Roth IRAs. And
Yes.
do you have a rule of thumb for that, or a calculation program you like to use for that, or what sort of process was that?
Well, we use HolistaPlan. So when we look at income taxes and whether we should be doing a Roth conversion, there's so many factors. You know, it's not just what tax bracket are you in, but we need to look at IRMA and Social Security effects and, you know, numerous other things that could potentially occur when you're even AMT potential issues. So we have to look at how it affects your full income tax situation when you're adding income by doing a Roth conversion, and what other income items they have. So we're going to look at everything through HolistaPlan and just make sure that it makes sense. Do they go up to the tax bracket, to the top of the tax bracket they're currently in? Depending on that bracket, do we go above? What bracket are the children going to eventually be in? So there's so many factors that go into that, but the client felt strongly enough that he wanted to leave the Roth IRAs to the children eventually, as opposed to taxable traditional IRAs.
Or as
that
opposed, or as opposed to
IRD. Yeah, I'm sorry.
Or as opposed to leaving the IRAs directly to charity.
That's true. He has left money to charity. They have a family foundation. I think that's on the next slide, I believe.
Okay.
Okay, so like I said, they have a net worth of about 60 million, 10 of which is made up of Roth IRAs. That's not counting their charitable foundation, the 2 trusts that are already funded for their children, and the 529 plans for the grandchildren. They've already used their full 13.99 million in federal exemptions and GST. There will be a $24 million federal estate tax at the second spouse's death if it were to occur yesterday, for instance. So they have choices, but they also, on top of that, live in Pennsylvania and are going to have a 2.7 million Pennsylvania inheritance tax at the second spouse's death. Pennsylvania has an inheritance versus an estate tax. And the way Pennsylvania handles that, assets going to children or grandchildren or lineal descendants are taxed at 4.5%. Assets to siblings is 12, anyone else is 15. So it can get pretty pricey depending on who you're leaving assets to. In this case, it's going all to lineal descendants, so it'll be at 4.5%.
Okay.
Next slide, please. So they have options. If the children really want the money right away and the parents are fine with that, they can pay the estate tax. We're talking significant money, but then it's available to the children in their trusts. And they could pass another 33.3 million to the trust for the two children if they go that route. Next slide, please.
So in other words, they could pass the assets after estate tax, both state and federal.
Exactly. But another option that we came up with was funding a zeroed out testamentary clat at the second spouse's death and putting into their living trust, because we don't know right now with the administration that we have whether we're going to see a repeal of the estate tax. We may not, but we might. And if that happens, they're not going to want to fund the clat. They're not going to need to fund the clat. So they can put a provision there. If there is an estate tax, then we're going to fund the clat. If there isn't, then we're not going to worry about that. So it gives flexibility. I think everyone that I've spoken to says flexibility is the most important thing right now, because we don't know what's going to happen with this administration or future administrations. If the estate tax is repealed, it could come back in the future. What's going to happen if it gets repealed with GST? Because there's no GST now. They're trying to get rid of GST and the federal estate tax. So what's going to happen with someone who didn't port over assets yet? They're within the 5-year period to file a 706. They didn't owe any estate tax. They're not going to be able to probably port over their exemption because there's not going to be an exemption anymore. So there's all these questions about what is going to happen. So to add flexibility, they would put a provision in their living trust that would say if there's an estate tax, they would fund a clat. It would be zeroed out. So there would be zero estate tax inclusion. And the question is, for how long would they want to do that? And there were a few options. So first we said, what if we do a 15-year clat? And we meet with the daughters as well as the clients together. And the daughters were like, well, that's kind of far down the road. And, you know, dad's been sick, but mom may live longer. So I said, well, what if we fund two? What if we do a 10-year and a 20-year? And the 10-year certainly will be used by the children, but maybe the 20-year will eventually be more available to the grandchildren in their trusts when the children die. And they seem to like that idea. They have not made a decision yet regarding exactly what path they're going to take. They're still making those decisions, but due to some health situations with the client that was the executive that we're working with, these are decisions that will be made in the next several months, certainly.
That's a great idea to do two clats and basically hedge your bets in and your timing. That's really good.
Yeah, and it really satisfies the concern that the children have, although they certainly have a lot of assets already in trust for themselves. This will give them additional assets that they can use because, like I said, the family has significant expenses because they own a lot of real estate, plane, other assets that are expensive. So their concern is not only do we have to pay for our standard expenses, but the family expenses that they would like to keep still even after their parents pass.
So Scott, a lot of the people on this webinar don't know what a clat is, or they don't remember exactly. So let's hear your best elevator speech. How do you explain to these clients what a clat is?
So a clat is a charitable lead annuity trust. So during the term of the clat, there are distributions annually to the charity. And at the end of the term, whatever's left will go to the remainder beneficiaries, which would be the trust for the children in this case. The charitable beneficiary can be their family foundation. There are some considerations that have to be taken into account, but that's what they would do. And the family foundation has been funded, will be funded possibly with additional assets using this clat. So they're very charitably inclined, and they've brought the children into the charitable giving over time so that they're also on board with that.
So the CLAT gives the person who died a 100% charitable deduction, even though it may tremendously benefit the family members after the 10 or 20-year term.
Because what we're doing is we have to use the 75/20 rate for the growth, but if we get additional growth, then that additional growth will go to the remainder beneficiaries, the children and their trusts. And that's the goal. So we're trying to help the charity, increase the foundation, that's the family baby kind of, that's important to them, and at the same time get additional assets to the heirs, but with zero estate tax, because we zero out the transaction in EstateView so that there will be no tax consequence. And they've been making these contributions for many years to the foundation. We just have to be careful whenever you use a foundation, especially as a CLAP beneficiary, we have to make sure there's no self-dealing. So we have to be careful that from this income, there's no salaries to the family or grants to family-run organizations coming out of that foundation. And the foundation has to qualify as a 501c3 organization. You also have to be careful because if the foundation for some reason were to terminate during the term of the CLAT, that could create a problem, especially if it's the only charitable income beneficiary. And the foundation typically has less deduction limits, less favorable limits than giving to a public 501c3 charity.
Now, correct me if I'm wrong, but the documents could simply say, on our death, create the charity that will be the beneficiary of the CLAT and figure it out after we die. Get together with our kids and the trustees and figure this out to get 100% charitable deduction for an entity called a CLAT that will make payments to charity for 20 years and what's left goes to our children.
Yeah, we always want to add flexibility, certainly. So that's something that we would consider, or we can name multiple charitable beneficiaries. So the primary would be the family foundation, but if that's not in existence, these are other charities we want to support.
Right. Now, do these slides cover the disclaimer of flexibility, or is that something we could talk about later?
They don't, no.
Okay. Okay.
So by making the full federal exemption amount deductions and transfers rather during their lifetime, they've been able to get a significant amount of assets out of their estate to the children. Now, the added benefit is not only did they make those transfers, but they've had the growth in those assets over time, which has allowed additional assets to pass estate tax-free. If they had kept the assets in their estate and not transferred them starting in 2012, they would only have the 13.99 million to transfer. But now by making those transfers over time, all that growth has occurred out of the taxable estate. It's been very powerful. That's one of the things I like to talk to people about when we discuss portability, because when portability is used, a spouse dies, another spouse lives 10, 15, 20 years, yes, they have the ability to port over the exemption that's unused, but that only covers that amount. But if the bypass trust is funded at the first death, all the future growth is also covered and out of the estate of the second spouse. So there still are benefits to funding a bypass trust today, even though you have portability. Transfer to the 529 plan, we're very powerful. We've got significant assets out of the taxable estate to the grandchildren, available for college. You can always change the beneficiary to future generations or other grandchildren if one doesn't use all of the assets. So that's a benefit.
Okay, so so for a typical client like this, you like the 529 plan and just do the gifting every 5 years, basically.
I think it's a good way to do it because then you have the additional growth also by front loading it. Yeah, you've used your 5 years, but all that growth on that larger lump sum is pretty powerful over time.
Do you limit this to what you think their children and grandchildren will need for education expenses, or do you just say, why not have more because you're going to go 1,000 years here with
Well,
education?
so in general, it depends. We talk to the client about what we like to do is explain everything to the client, have them make educated decisions, what they're comfortable on. Personally, I love your concept of the dynasty trust in the 529 plan. I think it's brilliant, and I think that that's something that I'm certainly going to be talking to clients more in the future, because then you're not limited to the 5 year of gifting because there's no gift, and there's a lot of benefits to that. So I don't know if you want to talk about that at all here, but I think that's a brilliant way to handle it, and I certainly am going to use that more in the future.
Right. What Scott's mentioning is you could just have the dynasty trust that you've already set up by the 529 plan accounts in almost unlimited amounts to get the income tax advantage. And then for the client's annual gifting, instead of gifting 19,000 a year or 19,000 times 5 into a 529 plan, every year you're gifting discounted LLC interests, which when you run the numbers on that, you may come out ahead depending upon your assumptions. We'll have to do a little EstateView analysis on that sometime.
It's a great idea. Yeah, and the Roth conversions will allow, like I mentioned, the children to receive those Roth assets income tax free, no distributions for the first 10 years under the Secure Act because they're Roth. So you can wait the full 10 years of additional income tax free growth before you have to take it all out by the end of the 10th year. So it's very powerful. These are going to be see-through, they are see-through accumulation trusts. Obviously, with accumulation trusts, when you're dealing with income tax issues, if these were traditional IRAs, you would have the issue of if the distribution of the RMD is not made. But what I like to tell clients is when the IRA RMD comes out, if it's a traditional IRA, it's a conduit trust to be a see-through trust. It's going to come right out to the beneficiary. Instead of the stretch, now they only have 10 years to lose creditor, divorce protection, distribution control, and it's going to hit their tax situation. If it's an accumulation trust, the RMD comes out of the IRA, stays in the trust in a brokerage or bank account, but now it's taxed at trust income tax rates, which are compressed at $15,650 in income in 2025. You're going to hit the highest 37% bracket. That's not an ideal situation because the individual wouldn't hit the highest bracket for hundreds of thousands in income. So we do have some strategies that some attorneys like that could potentially alleviate that. I'm not going to go into too much detail. I'm not sure how Alan feels about them, but there are strategies that can be used where you can get the taxation theoretically to the beneficiary and still keep the distributions, the RMDs in the trust for creditor protection. We tend to use those, and it's a win-win on every level, assuming it made sense to do the initial conversions from the traditional to the Roth. Certainly we looked at that.
Let's come back to that at the end of the presentation, even if we run over the 50 minutes or hour, because I do want to hear about it.
Okay, sure.
Yeah, okay, that's great. Okay, then we got the end result here.
Yeah, and funding the family foundation has allowed much joy for the family because especially the patriarch who was the executive, he is incredibly charitably inclined. He gives significantly more than 5% out of the foundation every year to charities. And he's incorporated his children in this decision-making over time, and they've become passionate. So they have these assets that they can truly benefit society. In their mind, it's great to give to a large charity, the Cancer Society, but it's even better for them to make grants to small charities where a large contribution can truly be a paradigm shift for that charity because they usually don't have a lot of money to operate on. And now they're getting a large donation out of a foundation that is transformational, truthfully. So they've liked to work with charities of all sizes, some churches, some religious organizations, and other organizations.
What is it that you do as a planner to help to encourage clients to try charity, try philanthropy, to ignite that passion? Because I find a lot of people would have just played golf and really not has had as much meaning in their life, but at some point in their 40s, 50s, 60s, sometimes 70s, they get started on the charity, and it means a lot to the whole family. What are your observations on that, and how have you helped that process, or do you feel you do help in the process?
Without a doubt, we do. So the firm I work with, we had a merger of 3 years ago of two firms. But the firm I was with prior to that, almost every one of our clients have a donor advised fund. And we talk about legacy planning. What legacy do you want to leave? How are you going to be remembered when you pass? Because your children will remember you, your grandchildren, but what about even future generations? And what about other people? And to them, they find that very valuable to make a meaningful impact into society. And whatever their goals are, they may have an interest in helping rescuing pets, or it could be saving lives for people who have cancer, or helping homeless people. There's so many charities out there that there's almost always something they can find an interest in. And it truly makes them feel good, because they're more than just their own family unit. They're impacting the world, they're impacting other people, and they've been very receptive. We've done that for many years.
And in this family, are the kids both on board? Do they want to work together on the charity, or are they going to go their separate ways with two separate charities?
I think a little of both. So they have some interests that are the same, and then they have some individual interests and interests of their children. So the goal is to indoctrinate each generation into charitable giving and philanthropy. And they do that by, even with the grandchildren when they're young, we're going to allocate $1,000 to you, $5,000. What charities do you want to help? You know, you talk about, oh, I want a dog. Okay, would you like to help dogs that are in need? And they try and indoctrinate them early and often, and it's been very successful. It's the way you present it. It's the impact you have on the world beyond just your family unit. And I think most people want to know they've made an impact of some sort. And it doesn't have to take a lot of time. It can be just a QCD. It could be, you know, an annual gift to a charity. It can be a foundation or a donor advised fund. There's a lot of ways to do that, or a charitable gift annuity even.
Right. And I think also parents like to think that their children and grandchildren and great grandchildren will stay together and work together in a charitable type of way.
Well, other than some of the issues we talked about with the CLAT, you could, in general, if you have a family foundation and it's large enough, you could hire family members to run that foundation. That could be their job. And if they're passionate enough, it may make sense to do that. They could be on the board. They could be heavily involved in many ways. And it's a powerful tool for the community, and the thankfulness from some of these organizations, especially the smaller ones, is tremendous, because like I said, it's transformational, and they feel that impact. They feel the gratitude from these organizations when they're making a large gift and that organization opens their eyes like, oh my goodness. I don't know if anyone saw the movie Mr. Deeds with Adam Sandler. So Adam Sandler inherits his uncle that he didn't even know existed, a whole entire corporation that is worth billions of dollars. And at one point he gets frustrated and he says, just write a check to a charity. And he said, what's a good one? And they said the NAACP. And he goes, okay, give them their $500 million or $1 billion or whatever. And all of a sudden you see the guy at the organization open the letter and sees the check and falls out of his chair, literally. And that's a larger organization, but the impact can be tremendous.
Absolutely. Okay, so Scott, do you want to share screen here and show us some numbers?
Sure. Yes, that would be great. Thank you. Can you see my screen?
I don't.
Oh, okay. Is it up now?
Yes, there it is.
Okay, great. So as your viewers probably know, with the EstateView, there's different levels depending on what you need for your organization. There's standard, there's pro, and then there's Pro Plus. The Pro Plus gives you the most capabilities to run different analyses. So we're going to do, you can do a grantor CLAT during lifetime, or you could do a testamentary non-grantor CLAT. Obviously, when the person's deceased, it can't be a grantor CLAT at that point. We're going to use the lowest available 75/20 rate from the last 3 months so we can get the best bang for our buck. And what we want to do is when we invest the funds, we want to beat that 5.2% 75/20 rate, because anything above that will go to the heirs eventually at the end of the term. So grantor's age, and life expectancy, they're saying for a 75-year-old is 87 years old, so that's a 12-year term. But we can do a term as well. I'm working on a couple of screens, so I'm having a little difficulty moving it. Term of CLAT here, let's do the 20-year first. So the 20-year was one option. Then we said, what if we do or I'm sorry, the 15-year was the first option. And then we said, what if we do a 10 and 20? The year of death, let's assume 87, which is their life expectancy. We'll show 30 years, even though the term will end at 15, we can show the effect of growth beyond that. We're using a 7.5% annual growth rate. We're going to use a 0.2%, which is what comes up as a non-grantor trust tax rate. I mean, we can change that to whatever we want. I'm just going to try and show this as an illustration. And the amount that we're putting in was, I believe it was 33 million.
Yep.
Discounted assets are zero. We're not using a discount. If we had LLC or FLP interests, then we could get a discount, maybe 25% or so, 30%. It depends on the assets and the situation. No discount rate. So actually, I think I put the 33 in there, but we're doing a 0% discount. Not sure why it's not. Whoa. That is not what I was trying to do. I apologize.
That's all right. Yep.
Oh my goodness. Do you have access to yours? I'll try and log in quickly.
Yeah, you just need your password there.
Yeah. Okay. I hope this was it. I don't know why it logged me out. Okay. Grant is the owner of our company, so that's why it said that. So let me go back through this. Grantor's age, 75. Term of CLAT, we're doing 15 years. I apologize for that glitch. We're doing 87. Okay. Okay, now, it's giving me a percent. Countable assets, 0. Well, it doesn't matter. We're giving 0%. Discounted amount. Yeah, combined value before discounts is, let me try 33. Okay. And time value of money, 5%. So now what we're going to do is at the very top, it says click to see results. So we hit click, and at the very top, you see the CLAT summary. So we can look at the total charitable payments over the 15-year term, 48.3 million, which is about in the middle of the page at the top. And we have the present value to charity, 33.4 million. Present value of the remainder, 9.2 million. So 9.2 million will go to the children, but that's going to grow over the next 15 years because we're showing 30 years here. So at the end of the 30 years, the value that will go to the children is actually going to be 39 million. So you're getting each of the trusts for the two children another 20 million at the end of the term, plus 15 more years. And we've received a charitable deduction up front for the present value to the charity. And we also have had the ability to zero out the estate tax. There's no estate tax at that transfer to the children or at the initial funding. Do you have any comments on that?
No, I think that's a pretty good result and not a bad way to show it.
Yeah, so we could have initially, I think it was 27 million we could have gotten to the trust for the children in total if we had paid the estate tax and the Pennsylvania inheritance tax. Or we can get over time a significant amount over a 30-year period, another 40 million to them anyway, but at the same time we're getting that charitable deduction and paying zero estate tax. What I like to ask clients is, who do you want to benefit from your estate? Because if you're in a taxable estate situation, or you live in a state where there's an inheritance or estate tax, you run into a situation where not 100% will go to your heirs, no matter what. So the government, Uncle Sam is a beneficiary of your estate, or the state that you live in is a beneficiary in many situations. So if they don't want Uncle Sam to get the money because they don't know what they're going to do with it, I'd rather choose my heirs and what charities benefit. Then it makes sense to use strategies like this, where you have 100% control of who gets it, and none of it will go to the government to potentially fund something that you don't support.
Now,
Could do the same.
Yeah.
I'm sorry.
No, go ahead.
I was just going to say we could do the same thing for the other two. When we're showing the client the outcome, we could say, okay, what if we do one that's half the amount? So instead of 33 million, we're doing 16.5 million. So it's half the amount will go into a 10-year, and then we'll do half in a 20-year, and then we can see the changes. So up here, total charitable payments are going to be 43 million. The amount at the end of the term to the children, present value of the remainder rather, will be 6.8 million, but it grows to 30 million at the end of the 30 years, what the children will have. Or at the end of 30 years. This is it with a 10-year with half. And then if we say, okay, then we'll do 20-year for the other half. So they're going to get another 48.5 million at the end of the 30-year term. And you're still giving to charity 53.8 million. So maybe they prefer to split it, and they'll get significant benefit. More benefit will go to charity over time, but the longer the term of the CLAT, the longer it has to grow. We know that markets can be volatile. We've seen that recently over short periods. But when you look at long periods, the market tends to have decent average annual returns. So the longer the term of your CLAT, the longer you have to beat the 75/20 rate, and then to grow after the term of the CLAT to continue to grow those assets. So the longer the term of the CLAT, the longer you have to grow it, and the more that will be available hopefully to your heirs at the end of that term. So doing half 10, half 20 isn't a bad idea, because some of it's going to have a significantly longer period to grow.
Now, do you show them side by side? Do you go ahead and start a new one?
Yeah, we'll show them. Well, usually I'll show them, I'll say, here's the first option, and then here's the 2 second options, and we'll have a summary. So the summary page we'll do in Excel. It'll show, okay, this is if you do the one, the charitable deduction, the amount on the government, which in this case would be 0, and the amount gone to your heirs versus the 2, and show all that in a summary page.
Got it. Got it. So maybe we
The
should have
great thing about your program is you can export this to Excel. You just hit the button on the right, and then all of a sudden everything now is in Excel, and you can manipulate things if you need to, or put it in different formats, however you'd like. So it's bringing it into Excel. Now, we can also do summaries of your strategy. I don't know if you see, do you see the Excel now?
Yeah. Mm-hmm. Yeah.
Okay, so it's all in Excel. You can add taglines at the top, you can add disclaimers or whatever you need at the bottom, and it's pretty powerful. And you also are able to create reports. So you can generate explanations for your clients and create PowerPoint reports that you can show to your clients as well from the strategy. So it's incredibly powerful. And the only thing we can't incorporate in here if we want to show taxation is the state tax, but that's incredibly complicated because every state has their own rules, whether it's an estate or an inheritance tax. It would probably take up so much computing power. But from a federal standpoint, this is mostly what they're looking for when they're at this net worth. Do you have questions that I can answer or try to answer?
On the top left-hand side, is there not a green duplicate button where you can show multiple plats across the top? For some reason, I don't see that.
I don't see it either. I've seen you use the software and do that, but I don't know why I don't have that.
Yeah. Okay, we'll have to check that out and see what's going on.
Oh, wait, here it is. Okay, I pulled it to the top. I apologize.
That's all right. So you click on
so we can duplicate it. We can run them without having to just change one scenario. We can run multiple scenarios right there. Makes it much easier.
Right, then you see the results side by side. Now, do you go to the married couple comprehensive and show them what that looks like?
It depends what I'm doing for them. If I'm going to show them this is your base and these are additional strategies and the implications of each additional strategy, then yes. If I'm just showing them one strategy, I don't.
Right.
But
okay.
I'm not an expert in EstateView yet. I've been using it for a number of months, but for the clients that have the net worth where it makes sense and the strategies make sense, I use it all the time.
Yeah. So I think let's go back. Is there anything else you want to show on EstateView, or should we just go ahead and stop sharing?
I'll give you back the screen.
Yeah. See where it's coming to.
Okay, it should have transferred, I believe.
Got it. All right. And let's see the camera. Where are we? Okay, so I think let's just have a little bit of a conversation here. You can see me okay?
Yes.
Okay. So I think it's probably best to stay on the subject of the CLAT. Are you familiar with what Jackie Onassis Kennedy did in her estate CLATs?
My understanding was she was going to use a CLAT to zero out the estate tax, and John Jr. and his sister said no. That's what I think happened, but
right. What she did, and we've done this, and clients have been happy with it. They haven't died yet, so we don't know if it's going to work yet. But what it says is 50% of my trust will go to a trust for my son. And if the trustee of that trust for my son disclaims it, to the extent disclaimed, it will go to a zeroed out CLAT. So basically, my son will have 9 months to convince his trustee as to whether to pay estate tax on that inheritance or let it go to a charitable lien annuity trust. And then the same thing for my daughter. So that way each child can separately have a voice and they can decide after the client dies. Now, some of you are technically inclined and you're saying, can you really do that? Because if the son disclaims it and then he has the control of the charity, is that a qualified disclaimer? And that's why the trustee, an independent trustee, would be the one to decide whether there's a disclaimer. And then there's also a question of, even if it's not a qualified disclaimer, because it's a completely zeroed out charitable deduction, would you need a qualified disclaimer? Now, we've been researching that and we haven't found any answers, but you can look at Jackie's last will and testament. It's out there somewhere, and see that that's what she intended to do. So I thought that was one thing. The other thing is, now you go to the client and go, hey, Mary and Floyd, you've made a great decision. You've decided that on the death of the survivor of you, there's no estate tax. Do you think you're going to change that? No. Do you think you're going to need any of these assets before you die? Some of them, but not all of them. Well, do you realize that if you start the CLAT now, then your children will get it that much sooner, and you'll get a charitable income tax deduction today? Scott, what are your thoughts on that conversation? Have you had the conversation, and does that work?
Yeah, I've had conversations certainly of setting up lifetime CLATs. It depends on the client, their situation. Like I had mentioned earlier, I like to present options and then let the client make an educated decision, explain the differences, pros and cons. So I think that's a great idea. It just depends on comfort level of whether they want to do that or not. These people could have done a CLAT in the past, decided to make gifts directly to their foundation instead. They weren't worried about the income. They wanted to get it all to charity. But in certain circumstances, I think it's an excellent idea. And regarding the Jackie O. Nassas plan, I think it's important that the trustee makes that disclaimer, not the beneficiary,
Right.
because the beneficiary is inclined, based on my experience, to not want to disclaim. I want the money today. I don't care if we have to pay. And sometimes that's also an emotional issue. Even with situations where there's disclaimers for spouses, their spouse just passed away and they're emotional and they say, I don't want to make any decisions for a year. Or I don't know. I don't feel comfortable doing that. So by having an independent party, the trustee, make that decision, I think is important.
Okay. So now I want to show off a little bit. I want to show off EstateView just a little bit here in a pertinent way. So I go to EstateView.link, I click on Instant Plan, and then I click on Calculator Only for my intake form. I click on Get Started, and then I'd like to show these people how a CLAT might work. And you said the person, I think the husband was about 70?
75. Yeah.
75, okay. So I'm showing a life expectancy to 87. And then the wife was how old?
She's like 73.
73, okay. So I'll put her at 73. And then I'm going to show they have their full, well, actually, I can go back and take away their exemption, but I'll just show they have a full exemption. And then we'll show they have some children and grandchildren. And then how much are they saving a year right now?
I'm not sure. One of the things is I focus on the estate and charitable, so we have other people that handle the cash flow.
Yeah. All right. Well, I'll just say they're saving $300,000 a year. I'll say they have a $4 million home or a $4,250,000 home. I'll say they've got $7.5 million in IRAs and other investments of let's say $25 million. And then they would consider a charitable lead annuity trust. So with that information, I will simply go to assumptions. Well, actually, I'll go to results. Now it's running all my calculations that I may need for them. And now I can go to Married Comprehensive, and I can see what their situation would be if they die at life expectancy, which would be in 18 years, a $36 million estate tax, with a credit shelter trust, a $34 million estate tax. If they put their home in their Cupert, a $29 million estate tax. With annual gifting, a $23 million estate tax. Discounted annual gifting, a $21 million estate tax. Life insurance trust, a $20 million estate tax. A large gift, a $13 million estate tax. Rolling grats, still a $13 million estate tax. Installment sale, a $9 million estate tax. And then finally, a charitable deed annuity trust. So if after all these different strategies, they still have an estate of $35 million on the second death and a $9 million estate tax. But if instead they will leave $23 million to a charitable deed annuity trust, then they will have a zero estate tax, which sounds great at first, but let me point something out. With no estate tax savings, the descendants get $103 million, cool cash maybe, on death. $9.3 million goes to estate tax. With a charitable deed annuity trust, they only get $88 million. They're $14 million short because $23 million has to go to the CLAT. But then, based on our assumptions, the foundation gets $14 million over a period of time. And then the way we're illustrating it, in year 20, the descendants get another $9 million. You can't really tell them exactly how much they're going to get at a certain period of time, but this is a conservative way of showing it. Now, the next thing I can do is I can go to save this to my calculators. So all this information is now saved to my calculators. Click on save. And now I'm going to go to a calculator. And the calculator I'm going to go to is married clients. And that information I just put there is saved there. By the way, the video on each calculator, you can expand the video and watch it, and it'll walk you through the calculator, or you could reduce it. So now I want to show these people no bypass trust, no Cuperts, no annual gifting, no life insurance trust, no large gift, no rolling grats, no installment sale, just testamentary charity. What's going to happen? And before testamentary charity, a $35 million estate tax. Descendants get $75 million. That's without any planning. A little bit different than what I showed before. But with testamentary charity, now you've got $89 million going to the CLAT, only $21 million going to the beneficiaries. So this can, certainly change what your decision making is. And then I can also show it as a timeline. So with no planning, when they die, the red is what's going to the estate tax. The green is what's going to be left for the descendants. But if they go with a CLAT, there's a lot more that has to go to charity to zero out the estate tax. So maybe they should use some of these strategies. Maybe they should do the qualified personal residence trust, and maybe they should do the installment sale. Maybe they should do a large gift. So now the kids get more, charity gets less. So this is where we, try to show the client that a series of strategies might be the best idea. And then we click on generate client letter, click on show all these strategies, or show whichever strategies I want them to know about. Maybe I'll pull some out to make it simpler. Click on generate client letter, and now it's creating a letter. And if anyone would like to see a copy of the letter, just send me an email and put the word letter in it. The letter comes up, and the letter is there for you. And the letter gives me my inputs to summarize the inputs for the client, and then shows me each of these, including, of course, 17 million of estate tax after all these strategies, with 93 million going to beneficiaries, versus the CLAT, which is 66 million to the beneficiaries, plus another 17 million in 20 years, depending on the settings. So, Scott, anything that you might want to add to that?
It's just amazing that not only does this handle the calculations, it can put it into a presentation format. And when you're using multiple strategies, it gives you the flow chart. So it's just a great tool to use with clients. And then when you fund the CLAT, you have the ability to use discounted assets too. So if you're putting in, LLC interests, that will change the actual calculations and could be even more powerful.
Right. So Scott showed, so the first CLAT that it's showing here is a 20-year CLAT with no discounts. So I'll just point out it's a 20-year CLAT with no discounts, and based upon a 7.5% growth rate, and the illustrated end value of $1 million. I put $1 million into a CLAT today. I get $1 million income tax deduction, and in 20 years, my children get $1.4 million in estate tax free, and I got $1 million deduction. Now, $1.4 million in 20 years sounds good, but we see here the real value of that is $340,000. But what the heck, if I'm going to get $1 million tax deduction and take care of charity and be able to have $340,000 of present value come back to my children, why wouldn't I do that? But then how do I make it better? I click on duplicate. Now I'm showing two separate CLATs, CLAT 1 and CLAT 2. And with CLAT number 2, maybe I'll go 25 years. Click to 25 years. And now my descendants are going to get $1.6 million instead of $1.4 million. They're going to have to wait a little bit longer, but look at that. The present value of what they're going to receive goes from $340 to $391. So I am going to do a 25-year CLAT. But let me go ahead and duplicate that. And now let's talk about if I populate this CLAT with an LLC interest, and I take a 20% discount, very conservative. So now you see this 20% discount. Well, now the end value is $3 million. It's twice as much if you could just take a 20% discount. And the present value of that is $718,000. And now to explain it, I click on generate explanation, and I click on CLAT 1, CLAT 2, CLAT 3, and PowerPoint presentation. It will automatically know my name and all that. It white labels that. Click on submit, and now it's creating PowerPoints. So there's the PowerPoint for illustration number 1. There's the PowerPoint for number 2. There's the PowerPoint for number 3. So what have I done? I've funded a CLAT, in this case with an $800,000 gift, because I put $1 million in, but I took a 20% discount. I got an income tax deduction of $800,000. It ran for 25 years, growing at 7.5%. First year payment, $57,000, and this is a level payment CLAT. And even with a level payment CLAT, the end result is quite positive for the family. Here's all my assumptions, and then there's the end result, a $3 million bonus for my descendants after I got a nice tax deduction. But Scott's now saying, wait a minute, Alan, you can make that better. Let's go back. Where did the EstateView go? Let's go ahead and do one more. And well, we'll do 2 more. Clat number 4 is not going to be equal annual payments. You don't have to make level payments to the charity. You could increase the payments by every 20 years. So the first payments are much lower, and then the payments get larger each year. So I'm going to click on increasing 20%. And now when you look at the spreadsheet, you see that the annual payments start really low. The first payment's only $4,578. The last payment is quite a bit higher. And now you've got 4 million ending up in charity based on a $1 million contribution, a $1 million charitable deduction, a 25-year charitable lead annuity trust taking a 20% discount. And then the final question that Scott says is, well, should it be a shark fin clat? Well, what's a shark fin clat? Well, a shark fin clat, the IRS doesn't say they like them, but a lot of authorities believe that they're perfectly safe. And with a shark fin clat, see the shark? With a shark fin clat, the initial annuity amount will only be 1% of the value, and then it will wait until the end and make a huge payment. So here you see annuity payments of only $8,000 a year with a final payment of $2.4 million. And with that shark fin clat, now you've got the family getting $4.4 million. Now, is that too aggressive? Maybe we should go with a 3% payment. Then it's at $4 million. Let's not be too. Let's go to 3.5. So it's only 3.9 million at the end. You know, they say in the tax law that pigs get fatter and hogs get slaughtered. So that might be somewhere between 3 and 4 is what a typical client is going to do. But that 20% discount is on the low side. So that's how you might use EstateView to educate a client. And once I've done that, I can now click on share with client and generate URL, and I can copy and paste this HTTP to an email, tell the client to use 676115, and they can run the software. They can run this for 12 days. That way you can collaborate. So
I'm sorry.
Go ahead, Scott.
I was just going to say, I think it's great you're showing different strategies using a CLAT, because a lot of people, when they think CLAT, they think it's one thing, and it's really very flexible. That's one of the reasons at the next NAPFA conference, I actually am presenting on charitable planning, and we're going to talk about step CLATs and shark fin CLATs, because people think, oh, it's a CLAT, but there's so many ways to structure it, and that's a lot of power.
Right. And you know, those of us who understand these techniques, it's okay to show ourselves 5 or 10 alternatives. But for a client, we want to keep it down to 2 or 3 so they don't get too confused. But with the other advisors, I want the other advisors to see what we're doing. So, well, Scott, as I expected, the time just completely flew by. You had a fantastic presentation, and I certainly hope that you'll come back and we can do this again with another 1 or 2 techniques sometime.
I would love to do it again. Thank you for having me. Your software is amazing. You're amazing. I don't know if people are aware, but you're doing the master class for Financial Expert Network. And anytime people can hear Alan speak, I think you gain a lot of knowledge. So thank you.
Well, thank you very much. I appreciate that. And I'm really looking forward to our presentation in, where is it going to be? Phoenix we're going to be? Or...
Yeah, it's in Phoenix, the beginning of May.
Yeah, tell everybody about that program. Some of these people may want to attend that.
Yeah, so NAPFA is a financial planner organization for fee-only advisors. And we have many different presentations on significant topics like cash balance, profit sharing, and money purchase pension plans. Alan's speaking on 2 different topics. That one of them is what I mentioned earlier, the dynasty trusts and 529 plans. The other is going through some planning through EstateView. We have someone talking about asset location in estate planning. Someone talking about BDITs, which are 678 code section 678 trusts. So if anyone's interested, please look it up, NAPFA, NAPFA, and it's the fall or spring conference rather, beginning of May in Phoenix, which May in Phoenix is hopefully going to be good weather. You don't want to go in August.
Absolutely.
Yeah.
All right.
And hopefully we'll get to spend some time together there too.
Yeah, absolutely. All right. So any questions, comments, or suggestions? You've got Scott's email address here, slevin@westcott.com. I'm agassman@gassmanpa.com. We always welcome your questions, comments, and suggestions. I hope that somebody watching this would like to give a presentation with us. You'd all be welcome. And Scott, thanks again. Appreciate it so very much.
Thank you and have a wonderful weekend.
All right. You too.
Take care. Bye.
Sure.